Welcome to the Consumer Code Show, where we believe that humans are incredible and we are living in a first era in history where behavioral data and AI have hit scale so we can go from consumer insight to business activation in no time. In this show, we explore the world of retail through the lens of demography, cartography, ethnography, and the economy. So without further ado, let's get into this episode. Okay, today I am joined by Thomas Paulson. He is the head of market insights at Advan Research and a guy that I've been paying a lot of attention to. And I feel like, Thomas, I've learned a lot from you this year, specifically reading your blog and just hearing you talk about things and the few cool webinars that we've done on GLP-1s, which has been really fun. But for the folks listening, could you tell them a little bit about Advan and what you do there?
Yeah. So Advan is a location analytics firm. So we see the foot traffic and the spend for any physical location in the United States. So whether that's a retailer or a shopping mall or movie theater, but things could be like things like a theme park, or it could be the visitation to an airport. So we have great visitation data of who's going through Orlando or who's going through Vegas in terms of the airports. So then, any place in America could be a manufacturing facility or a warehouse. And so, for example, Amazon has really big warehouses called fulfillment centers. And so we geofence those fulfillment centers, and, roughly for any kind of supply side real estate, the number of shifts work is proportional to the number of boxes they pack or the number of uh, um, Rivians they made, or the number of Teslas they made, or the number of semiconductor chips they make, particularly when we get back into making semiconductors. So it's kind of looking at both the supply side of the economy and the demand side of the economy. And so what I do is try to create insights with the data that give a novel view into some economic, some brand, some industry dynamic. And then I also lead our go-to-market trying to figure out solutions for new verticals that haven't used this data before. So, for example, auto manufacturers haven't used this data, but we have a lot of efficacy for auto manufacturing, understanding your pace of your business and your competitors' pace. And like if you take example of Tesla, they have great data. They know people who's coming to their website, who's coming to their showrooms, and you can see, how they produce their monthly production numbers or monthly sales numbers that are picked up by other data sets. But really what they do is they use that insight from the website and the showroom visitation to understand the demand in the market. And then they moderate their production levels relative to what they're signaling. So it's almost a real near-term indicator for, like, say, Tesla, what is demand.
Mm-hmm.
So that's what I do.
Yeah, as as an economist, the data that you get to play around with is just an absolute playground for you, and it's just cool to see you in your flow state and your sweet spot on your newsletter. But I got to know you at Advan when you're working with mobility data and credit card data, but that wasn't always what you were doing. You actually started on Wall Street. How has that impacted how the lens that you use to look at some of this retail data?
Yeah, so I worked as an institutional investor, portfolio manager, analyst for managing very large pools of money. So worked on one team, we managed 82 billion. That's a big number in relative sense. And that was a long time ago. That was like 25 years ago. So that would be, probably triple the number right now if you were to mark it up to current dollars, a third of $1 trillion or something of that nature. And then I worked on another team was about 16 billion in assets under management, and, really trying to figure out what was happening, um, tomorrow, or what's happening around the corner, or what should I look for around the corner. And really, when you're managing those large pools of money, you can't, just flip a switch on buying target today and selling target tomorrow. You would have a huge impact on the stock either way. So you have to be very, very early on big trends. And so lasted doing that for over 20 years. So I had to be pretty good at it to last that long. There's a lot of churn that happens in that industry. It's a hard job, hard seats to find and hard seats to keep. But, so you kind of learn how to understand bigger trends, and for businesses, what their unit economics are and really what their drivers are, and, whether they're astute business peoples, whether they got, good business model in terms of first principle value drivers. And then, in that seat, you just are consuming a mass of information, like 3 or 400 emails a day, every financial press outlet out there. You're doing tons of earnings calls and conferences. And I was on the road like a third of the time going to visit different companies. So you're taking a huge amount of information from a large swath of sources, and you need to be able to successfully synthesize that down and pull out the signal from the noise and then effectively communicate that to your bosses, which are effectively the portfolio managers. This is what's important. This is what I learned. And so it's that kind of what I learned that I try to bring to the Advan blog. I use our data, but I use a lot of other data. I use a lot of other
Right.
insights. I use a lot of conference call transcripts, quotes. I use a lot of, government data. I look at like other third party data sets like Circana, which is IRI and NPD. So you're trying to create this whole. I mean, so we have great data that gives a view into a dynamic, but it's not a complete view. You never have a complete view. You try to fill in enough pieces of the mosaic that you feel comfortable with whatever the narrative is, but you don't have all the pieces, and nobody ever knows, until the history plays itself out in time. And so one of the things, having done that for a long time, seeing a lot of companies, seeing a lot of history, seeing a lot of industry evolution, I have a lot of parallels I can bring to my stories. Like, this happened in the past, or this is happening in retail, but it happened in media 2 years ago, and this is why it's
Hmm.
important to retail it in terms of what's happening. And obviously, so a big part of retail this year and last year was retail media networks. Okay, well,
Hmm.
that was a play already that we had seen with Amazon, and in terms of what they were doing with their ad business.
Yeah. Yeah, I've that's one of the things I notice about you is I think I expected you because you're at Advan and you just had access to this mobile data to wield that mobile data. But what I actually saw you doing is looking across different data sources. I've seen you use census data. I've seen you use mobile data. I've seen you use credit card data. I've even seen you use civic science, which was it's basically like real time qualitative surveys on the internet as ways to like fully flesh out, and that's like really bringing in like a qualitative view to fully flesh out what is happening in a situation. You've used our data too. You've used
Yep,
the psychographic data as well.
all the time.
And
Sharp
I
data.
guess for me, the way that I respond to it is it feels like you're getting at it from a lot of different directions, but the stories that you tell, they're sort of like multifaceted and multi-layered. And I just really appreciate that and love that.
Yeah, and so I try to again try to pull out big picture, big stories that that narrative is going to be durable for 2 or 3 or 4 years. And so one of the big things that everybody's talking about this year around the economy and the consumer is our K-shaped economy. Well,
Hmm.
I began talking about our K-shaped economy in the second half of 22, like way before it became a popular narrative. And so, 2023 was, really a defined K-shaped economy. 2022 was the beginning of it, but then in 23 it became really defined, and then 24 became extended, and 2025 has been a further extension of that, particularly in the second half of 25, where the high end is really jacked up in with wealth effects here, and going in the second half of the year, where the lower end has become more and more concerned about another bout of inflation, and they've become more careful with their spending. So, it's, again, that's a narrative, that's a trend that I first was talking about in 2022. And, we'll see if we keep talking about it in 2020, um, 6. We can talk about that later.
Yeah, we'll dig into the K-shaped economy. I kind of want to set the table too for the retailers who are listening, and why are we talking to an economist or a kind of a Wall Street guy? The retailers that are listening are not going to do the deep dives, Thomas, that you do on all this stuff. But what would you say, like, what's the terminology and the concepts that a retailer would need to know in your world that's going to be useful for them?
Yeah, I mean, there's like two things. I think there's a couple words that I think are very confusing to people, but are important. So, Wall Street analysts are divided into two categories. There's the buy side analyst and the sell side analyst. So the buy side analyst is the person who actually owns the stock, who makes a decision to buy. So that might be somebody at Fidelity or Janus Henderson or at Point 72. So they're the ones who actually own the stock. Actually the ones who dictate the stock price movements. But sell side might a little bit, but it's really the buy side. And so the buy side is, a large group of peoples. There can be cobbles. So there can be like a retail mafia or a media mafia of people on the buy side who kind of just collaborate and can somewhat control the narrative on a given big company, and what the stock is doing. And then you have the sell side.
Is
So the
well,
sell
is that even legal? Are you allowed to do that?
Well,
Not
it
really.
existed in the past,
Okay.
it's not necessarily they're misfeeding information, but they're working a narrative together.
They're creating some signal around
Yeah,
something. Yeah,
yeah,
yeah.
yeah. And then you have the sell side, which would be like a Morgan Stanley, a Goldman, a B of A, et cetera. They don't really set stock price directions. I mean, they put narratives in play, if you will. They'll talk about what they're hearing from their buy side customers, and then they'll kind of like bring that in as an idea. This is what the buy side. When they say what does the market think? I mean, they're talking to a bunch of buy side customers. They sit down with their people, their customers at Fidelity and Janus, and okay, and they give them their view and what they ask them what they view. And don't you think, like, say, Amazon is like kind of completely played out here, and they try to kind of pick out the information from the buy side, and then they put that in their earnings estimates and whatnot. And you could say, okay, and it's generally like consensus estimates. Generally, consensus estimates are aggregation of the sell side estimates put together by like a firm like kind of Visible Alpha or Bloomberg. Now, that's not necessarily what the stock price is set off of, because that's their numbers. That they're not the one who buys the stock, but they have a high level of publicity, and they're the people who show up on CNBC and et cetera. So those are the kind of the two dynamics, and it's an important, like when you look at stock price moves, like it's not an analyst upgrade or downgrade. I mean, that might have a 1 or 2 days impact. It's not going to have a long term impact on a stock price. And in terms of judging, whether results are good or whether strategies are good or bad. Don't be fooled by near term or short term stock price moves. There's a lot going behind the scenes that you just won't know unless you're sitting on the trading desk at Goldman or B of A or Morgan Stanley, et cetera. So, for example, Target rose 28% from August 1st to September 12th in 2008. The S&P dropped 12%. So you could say, well, stock, like going into the great financial crisis, like Target looks like the stock's going up. I guess everybody feels safe in Target,
Hmm.
and then, everybody who thought that and bought Target had their head ripped off, because really all that was, tons of hedge funds shutting down their book going into the financial crisis, knowing that there was no way to protect capital. And so they were all short Target and just covering their short, which is what pushed the stock up versus the
Hmm.
markets. So I kind of say, in terms of understanding, a business's position and a company's strategy, you don't really need like probably at least 2 years to kind of make that assessment. Okay, the stock outperformed by 100%. Okay, over a 2 year period of time. And that's a pretty good reflection of the company and its business and management execution. But if you're taking periods of time of a quarter or of 6 months, I don't think that's really a relevant time period to be making those kind of judgments.
So don't react to the up and down day to day of the stock.
Don't
You
make a
should
judgment
really,
off of it. Don't make a
yeah.
judgment off. You could say, "Oh, they had terrible results. The stock dropped 12%." Maybe. I mean, maybe that was just an expectations game. Maybe, they still put up solid unit economics and good earnings flow through, but it just wasn't up to whatever the expectation was at that moment.
How should, like, for example, marketers respond to the public's response or the stock response um, to their moves? Should they just like totally ignore any of that? Or is there any signal that they should be paying attention to it?
Yeah, it's a tough one. Again,
I'll
I
give
think I
you
would take a, longer term perspective, and I think, probably watching competitors' stocks going up or down might be an important signal to either dig into they're doing something interesting right, or they're doing something that's eroding confidence. Stock prices move a lot more than the estimate. So, an estimate, like say a stock price might be plus or minus like 10%, right? But the estimates might only move plus or minus 5%. The bigger, or call it plus or minus 2%, the bigger move is the valuation, the multiple. And what's moving that multiple is investor expectations about, you know, whether their addressable market is increasing or narrowing, whether competitors are encroaching or receding. And like competitive encroachment and rescission is probably the most important driver of valuation multiple. And so that's somewhat, competitive moat. Some of that is economic cycle. Some of that is company execution. But it's really that competitive rescission or encroachment that is really impacting the multiple, which is having a much larger impact on the stock price in the near to medium to longer time than the actual estimate direction.
I'm thinking right now about Lululemon as it relates to I think the response in their stock, which has gone down. Ha-
Precipitously.
yeah, I mean it feels to me like it's like we see Viore and Aloe really taking some share here. Um, and I'm wondering like what of Lululemon should we be paying? Should they actually be paying attention to that? And how does that affect the business? Like when they have a
Yeah, I mean,
lower.
yeah, it's a topic that I've kind of written about over the last nearly 2 years. And there's a lot of feeling about that, and competitive encroachment was the primary contributor to them slowing. And I have a little bit of a different take on it. So yes, might be on the margin. They self-admittedly had product execution challenges. Um, and, when they had, first things first slowed, they were coming off of a really hot product cycle with their belt bags and whether that was sustainable product and, whether that was just a one shot on, lucky shot on goal, it kind of could be debatable. But I think really what happened more significantly to the category was, obviously we had, it's kind of a little bit of reflection of the pandemic and normalization post pandemic. you know, 21, 22. Obviously their core consumer was feeling good about their employment prospects and their income prospects because things were it's really easy to get a job and everybody's easy to ask for more money. You had lots of stimulus and you had, less places to spend your excess cash because we were still coming out of the pandemic and, not all of the services that uh, the services sector was still coming back, later from the pandemic and not in full fighting form for your dollar. And so I think what happened is that, it became a hot category, a category where consumers were willing to engage and spend, and influencers, being very perceptive creatures, picked up on that. And so they just went all out on boosting Lululemon because, they were creating a ton of impressions and that was driving their own revenue and
Mm.
everything was just powder keg up. I always say that, everybody understands that social or influencer media and social media is really consequential, but it's really hard to quantify it, in terms of the data sets that people have. So I always think it's still a little bit underappreciated. So you had this huge wind in Lululemon sales. Their customers were flush, customers were stuck at home, or customers were starting to go engage back out socially and around, and you had all this social influencer wind in that sale or blowing on their sale, etc. And then what happened is, when we get into this 23, going back to the K-shaped economy, the consumers became a little bit more choiceful. There was more competition for their dollars with, entertainment and travel. And because of the high rate of inflation, people became starting to becoming looking for ways to spend less. And so the influencers detected that and really started to shift their focus to dupes and ways of saving money versus paying full for
Yeah.
Lululemon. And so you kinda have this, like, this extended bubble of Lululemon, and then the pin pricked it, and it's just been a hard reset after there. So I think, management got way overconfident that, they got maybe lazy on competition, they maybe got lazy on product because everything was just really easy for a long time, and it's really easy to get fooled when everything is really easy. And so it just inflected on them, and they're just still still picking up the pieces, obviously, given that they just are decided to change CEOs and everything. But I think a lot of it has to do with coming out of the pandemic period, stimulus, influencers, and then raging inflation in 23 and 24
Yeah.
versus Bjork.
Yeah. Yeah, exactly. And I kind of think about my own analysis that I'm doing right now, and I'm just finding categories shrinking. And it's like the category's not actually shrinking. It's just that we're coming out of like this world of 2021 and 2022 where things were massively inflated. But what we're kind of talking about is getting at the K-shaped economy because theoretically, you have Lululemon that should be sort of like their consumers are, they're moving up at the top of the K, but can we just talk about the world that we're in right now? So you mentioned that the K-shaped economy is extended to the second half of 2025. So what does that actually mean for retailers on the ground?
In 25 or 26?
Well, I
25, it
mean,
means 25, I mean, 25, I mean, generally, the more you cater to, the middle income, lower, I mean, you're just very volume challenged, and if you're right in the high side of the K, like really high side of the K, like premier prestige luxury, like we're talking like Hermes, Cartier, you know, when the Bellagio, things like that, it's life is great because everybody's got extra dollars because they just made a lot of money in the stock market. If you're more of the moderate mass, it's a more of a challenge to get volume, and particularly because pricing just went up a lot during the pandemic and people are
sure.
rejecting that price. So if you're looking at the spirits category is like got the worst hangover it's ever had in its life, maybe
That's a
other
good
than,
joke.
prohibition. And a lot of that's because they took too much pricing. If you took it Vegas, like Vegas charging, 150 or 500 for a poolside seat and $20 per beer and $30 for a cocktail. It is priced themselves out of the mass market. And so, they're having to return, and, offer more and more discounts, to bring those customers back to Vegas. And, they're challenged because Cruise saw this opening. And so Cruise just really pressed the value message. So Carnival, Norwegian, Royal Caribbean, hey, we're a great value versus, say, going to Vegas, or we're a great value versus going to Universal
Mm,
theme parks or SeaWorld. And so, like the destination resort parks, with the exception of Disney, are also, really challenged because they took too much pricing. They raised the price of hot dogs and sodas too much. And, so they just, are really hurting from a volume perspective. Same thing, kind of limited service, casual, Chipotle, Cava, they all have good product, but they took perhaps their mix too high.
yep.
Sweetgreen, they took it's like
Sweet
great
green.
product. I mean, it's a great value, but this the dollar price point just being too high, or people associating it with a dollar price point that is too high. They just are moving to food at home. Or, maybe to a degree going to QSR, but I think more it's like a substitution on going back to, more home cooked meals because that fast casual thing was really a home meal replacement. So volume is a challenge, and I think that's what's going to be really interesting as we move into 2026 is how much margin do these brands need to give back to lower pricing to get rebuild volume. And you're seeing it in packaged food, really sharply right now. So last week, Campbell's reported their results. Their U.S. volume was down for what's relevant for Campbell's. Their U.S. volume was down 3%. Their profits were down 11%. segment profits, and they're guided for the rest of their fiscal year profits to be down EPS wise mid-teens. And I think, we're going to see that across packaged food. The spirits category has had a huge margin reset, same thing. So it's kind of, we'll see which brands have to invest back. And so I guess if you're not, either in deep value like a Costco or a Walmart, or if you're not in super premium prestige luxury like a Wynn, Hermes, or Cartier, it's going to be a tough margin, at least for at least for the first half, and I would expect for Q4, as we try to kind of rebuild. We have to reinvest to rebuild the volume that we're there. So, and then if you're you know the less the like the definitely like the lower income. I mean, there's been some great articles in the Wall Street Journal about people just cutting back on portion sizes, meaning that they're using half their toothpaste or half of their shampoo or half of their detergent. And, probably is a pretty good time to be at Church and Dwight, which is kind of a hard value. And I'll have to see what they report for Q4 when they do. So anyhow, that's, I guess, my thoughts on that.
Yeah, I think what's standing out to me about what you're saying is the actual thrifty part in the thrifty K-shaped economy.
Yep.
Is it really is? It's like that K feels short to me. The upper one, just like there's
Yeah.
not actually that many people up there that are having a great time, but the thrift in the bottom is a big part of it.
Yeah, I mean, and I think, it's like, and it's like those everyday items that people cut back on or look to, go lower. So that's like the grocery category really is being driven by private label brands
Hmm.
and the retailers that thrive in them, whether that's Aldi, Trader Joe's, Costco, Sam's Club, Walmart to a degree. Or Kroger talked about, how their private brands continue to outperform when they reported results last week. And so, that again makes it a challenge for the national brands, because that's not by definition, that's not them. And you have so much share of
Right.
stomach going to those private brands. And then, the other dynamic, which I think about in terms of discretionary, like, it's again, like just finding ways to save money on every items or on goods. Like if you look at Costco, which is really leveraged to the top half of the K, their general merchandise sales versus 2019 versus pre-pandemic are up nearly 90%, which is just, almost near doubling. And when they reported results yesterday, I also thought it was really interesting that their executive membership is now, in terms of the total number of executive members, is double than it was pre-pandemic. So that's people looking for value and affluent people looking for value. By
Yes.
contrast, if you were general, your general merchandise sales during that versus that pre-pandemic are flat, or as if you look versus 2 years ago, their general merchandise sales are down about 20%.
Yes, yes. Yeah, okay, and so you're saying, especially with the Costco example, even the wealthier group, which we know the Costco focuses on, or at least this big portion of their sales, those people are also looking for value as well. And you were getting into a little bit of this with the private label stuff.
Yeah.
What do
Yep.
you think about private label? Are we seeing right now a like a trend in this direction, or do you think it's like a structural thing that will or is here to stay?
Well, yeah, it's a great question. And, I think pre-pandemic, there was a slow trend towards private label. Excuse me. I think, and then during the pandemic, private label was de-emphasized because we were short capacity and just national brands got the capacity for manufacturing. And then we're coming into this period of time where private label is taking a lot of share. And I kind of would say it's pseudo cyclical and somewhat and so the trend is a secular trend, but it's been really amplified in 24 and 25. And so I think you have this longer term secular trend, and then you have this cyclical element on top of it.
What do you mean
Um,
by when you say secular? What's your definition of that?
just being ongoing, just like
Okay, got it.
it's a long term trend, and then you have a signal, or then you have a wave, a cyclical wave on top of that.
Okay, got it. All right.
But if we look between 22 and 25, Aldi went from about 28.6 billion in revenue to 39.5 billion. That's $11 billion of private label, right? And then the overall food at home market, though, is large. It's 1.5 trillion. So they took about 100 basis points of share during that period of time. Um, so and that, obviously preferences the largest brands. And so I think one of the, again, another dynamic in terms of national brands is like that kind of items that can be stored away that I can go in and do a power shop at a Walmart or a power shop at Costco. It just really, then I'm not buying those at my everyday grocer, right? So this share of stomach, this market share of these categories, particularly flowing to these large brands. And you can have every grocer that's even Aldi's or Albertsons will say, well, our center store sucks and our perimeter is doing great. That's because of better for you. That's true. But it's also because they're not getting that pantry load. That pantry load is happening at Walmart or Costco. And so again, if you go back to the Campbell's example, like their margins got whacked. Part of that was
Mm.
mix. Part of the mix is this channel mix from, smaller regionals that they made a full dollar on their item now to these big scaled retailers that can beat them down hard.
Wow.
It's a really structural challenge for national brand food. So you have this shift that or channel shift that's happening. You have the better for you channel shift, that their portfolios might not be on the money for the current better for you trend. They may not have enough proteins, whatever. And then you have just GLP-1s that, are cutting out the consumption by super eaters, particularly in their categories. So lots of pain.
Yeah. When you say better for you trend, are you referencing Kroger specifically, or is that something else?
No, I'm just speaking more. Yeah, it's a great call out. I'm talking about, just broadly speaking, there's a trend for better for you eating, better for
Yeah.
you drinking. And so better for you has definitely been impacting the bev alc space, where beer consumption and spirits consumption and wine consumption or the wine industry is in a world of hurt right now. So it's just, some of that's GOP, some of that's just I don't want to drink. There was obviously a binge in drinking that happened in 21 and 22. It's, I think from a consumer psychology perspective, there's like this little bit of a whiplash turns against that. And then you can see it in the innovation that the General Mills or the Conagras are talking about. They're all talking about, coming up with all better for you alternatives. So that's telling you that they're trying to respond to the consumer, and I think they'll be successful to a degree, but that means that you're having to reinvest in new brands and new product offerings, and that means the brand equity of your legacy brands are declining.
Um, just a note on the alcohol stuff. Something that I think I've heard that was really interesting theory is, um, one is that Aura Ring. When the Aura Ring came out,
Yep.
people saw
Yep.
that the drinking alcohol like smashed their sleep scores. And the other
Yeah.
thing is Andrew Huberman, and I have a very specific experience with this. So our data scientist had listened to an Andrew Huberman episode. He's like a health, I would say, influencer podcaster. He just did
Hmm.
this big episode on alcohol. He's like, yeah, it's pretty much not good for you. And in no way is it good for you. And I sent it to my wife. I didn't even listen to it, and she quit drinking alcohol. And I'm like, man, if the alcohol companies could have paid somebody off,
Yeah.
they would have got 10x ROI on just giving Andrew Huberman $1 billion.
Yeah. And this would be another example of that the impact of influencers, right? And I don't know if Andrew Huberman, this is like just his mission, or whether that's the content and the narrative that would he could connect on with consumers right now, and that would fuel his advertising dollars.
I want to talk about Black Friday because you came out with a really good article about it, just kind of breaking down everything that was going on. Or maybe I just had saw a slide from you, but give us the download on what happened this Black Friday.
Yeah. So, obviously, a shopping event that's of high focus by the media and retailers. And, I think what we've seen, every year since the pandemic, is this kind of this more, when it's a high seasonal period, when it's, uh, there's a high need, when there's deals in there, the consumer comes out. So, overall, we saw a good response by the consumer, and, everybody knew that they wanted to win it. So, particularly big splash on digital deals, and Best Buy saw a great Friday, in terms of foot traffic and spend. Um, but there was a few headwinds to this, Black Friday. So one, it was the snowiest in 40 years. It was darn cold in particular areas, so it doesn't make it necessarily comfortable to get into the car and go to the mall versus, just picking up all these great deals at Amazon or Walmart or et cetera, are putting on their websites and listing. The other thing that happened was that this year, in terms of the box office, you had Zootopia 2, which as a film did great, but as a overall box office for the weekend, you were comparing to Moana 2, Wicked, and Gladiator 2. So, the box office was actually down quite a bit, for the Friday, Saturday, Sunday period of time, and if you do the math, it was about 8 million fewer tickets sold. And if you
Mm,
just say most of that was at malls, or shopping center related malls, that was about a 230 basis point headwind to traffic for those malls. So I think that was one headwind as to why mall traffic was down for, those 3-day period. Another curious thing was that Saturday mall traffic was down, um, about 4%, but Sunday was up about 5%, Sunday being a little bit less of a day than Saturday. And so what's the difference between Saturday and Sunday? Well, the only thing I can really see is like college football versus the NFL. And in other element to that, you had YouTube TV come back on after being gone out for two weeks. I watched some of the, Saturday games, and I thought they were pretty compelling matchups, and so I think perhaps the college, um, games were just had maybe a stronger draw on consumers than the NFL on Sunday, or at least they sat around watching the college, and then they said, "Okay, I gotta get to the store," so they came in on Sunday, so that's why you got this Saturday dump and a Sunday bump, is I think a little bit just the difference between the college league and the NFL league. But I don't have anything to prove that other than the ratings for the college games were really robust, and I thought the matchups were pretty compelling.
yeah, man, I wish I could talk more about football. Unfortunately, I don't watch it and I can't. But I wonder if was there a geographic skew, or did you look at that where it's like, is that the Northeast mainly drove the Sunday visits or something like that?
Yeah, no, it's a that would've been a great way of kind of, trying to peel the onion one layer lower, and I didn't take that last peel.
I'm just kind of wondering if the weather continued to be bad in the Northeast states or something, and maybe that was part of it. You mentioned that you've been doing a little bit of research since. Like, what has happened since Black Friday? What have you found so far?
Yeah, so again, this even flow, so kind of after post Black Friday, things have stepped a little bit lower. I expect them to pick up really over the next week as we go into the 24th. So just a little bit slower. Um, I would say sporting goods continues to be a very, very strong category, versus fiscal Q3 for the brands. Five Below continuing to just, rocket. The trend in foot traffic is stronger than the trend in spend, so I think that really indicates that shoppers are out there looking for deals. We're seeing that obviously in the size of a smaller basket size. Sporting goods really is the exception to that. And we've heard from a lot of retailers, and commentators that people are hunting for deals. I think for like say Apple and Best Buy, I mean, I think, that Black Friday was the big push. Apple is healthy, but it's less than the prior trend. I think, part of that is, there's a ton of excitement about their product launches in September, and, so, that was kind of a bump to theirs. Amazon continues to produce double-digit sales growth. Walmart, is outperforming. Things for the department stores and Target are, I would say, a little bit more neutral relative to fiscal Q3.
Boy, that was that was a lot of stuff going on. I mean, overall, how did the after Black Friday? How did you expect it to go down, and then how is
I
it
expect
going
I
down? If you could
expect
give
I
me a theme.
expect I yeah, I expected things to soften a little bit post Black Friday weekend, and then again, I expect them to pick up, um, in the next over the next week, and I'll have another report at the right before Christmas on that. But, so that even flow. So, like, we had a just back to school season like no other this last fall, and so that's but it came early. So, like, dollars flowed into July, more dollars flowed into August. Very little was left over for September,
Hmm.
which was one of the reasons why September was a softer month. And so consumers, that's a big event for family households, and so consumers showed up. Walmart had a gangbuster, and Best Buy had a gangbuster back to school season.
What retailer in 2025 has been one of your favorite ones to watch?
Yeah, I mean, broadly speaking, I mean, we've had this year in retail, we've never had so many retailers go back to basics, trying to stabilize, and I think generally kind of the back to basics kind of have been good ones to watch, and fun ones. I mean, the ones that kind of I thought were interesting, particularly interesting. I mean, like American Eagle just pulled a rabbit out of the hat, just massive success with, getting 2 highly influential people to be kind of endorsing their brand, and so that's been, pretty stunning. Um,
Well, real
you
quick
know
on American Eagle, they had that. I can't remember, but they got some actor or influencer that was controversial, something about jeans. That was one, and who was
Yeah,
the
that was
other
Sydney
one?
Sweeney. Yeah, Travis Kelce. So it's
And
Sydney
it's
Sweeney, and they both really, and there was a lot of reports out there that, Sydney Sweeney in late August, early September was having no influence um, on the brand, and that wasn't true. I could see the traffic improving in their traffic trend improving, and then when they came out with their earnings results, I mean, they just put that rumor to bed with a lot of anecdotes with billions of views, et cetera, et cetera. So I have a nice story in my blog, talking about, that campaign, and they just reported, results. And again, those 2, influencers are, having very nice lift to their business. They're sold out of the product, and it's, I think, really given a shift of perception around the brand. So we'll see, how that persists in 2026, but I
well,
think
do
that's
you
been a
think
pretty
so?
interesting story.
It's that. Would you say you can primarily point to those two influencers as the reason the brand kind of took off?
Yeah, those 2 influencers and having the right product and the right creative around
Yeah.
their merchandise and the campaign. But it was one of the favorite ones to watch because, the trade rags, before they reported their earnings results were completely back as wrong. And
Yeah.
so, so it's really fun to be able to show with my data that they're misreading the data, and then in fact my read was right. And there's this, you asked me a long time ago in a conversation about, what I learned from Wall Street. Understanding data and reading data is not a given. It's a skill. It's a really hard earned skill to really normalize and try to understand, what is the trend and what to actually compare to, in terms of time periods. Like, for example, in February of last year, Um, Again, the trade rigs came out, said traffic at Target is awful. It's down 12%. It's a disaster because of the reversal on DEI initiatives and their business. And then they came to March and the traffic is down. Traffic wasn't down that amount. If traffic was down that amount for Target, we were going into the great financial crisis, right? Their business was not maybe helped by it, but not down 10, 12%. And again, I was able to dig at our traffic and it wasn't nearly as, it was down. It wasn't good, but it wasn't nearly as bad as what was being in the press. So, that's kind of a misread in the press of the data. And one of the things that they were misreading in the data was they weren't including the fact that there was no extra leap year day in 25 versus 24. So just on a given month, that would have been, a 300 basis point plus headwind. And they didn't correct for that. And those type of things. So it's fun to be able to read it, to be able to be able to really interrogate data and try to drive real insights versus this blather.
You're about to mention another retailer that's been fun to watch, and I cut you off. What was that retailer?
I mean, I mean, Walmart has just had just a remarkable run, hit it out of the park, and so they got, uh, one cyclical driver there, and they got a couple secular, internal initiatives. Cyclical one is just they're known for everyday low prices. Consumers are looking for low prices. They're going to go to Walmart. So that's just like kind of cyclical, yay. But then, boosting on top of that is two things. One is, making accessing the product incredibly convenient, either through curbside or,
Mm.
ramping store delivery. And when they ramped store delivery, I mean, that was a little bit controversial. That wasn't necessarily how most were doing it. I mean, most were using third-party outsourcing or just relying on curbside. They went heavy in store delivery, which gave them, access to more affluent households who are willing to pay for that delivery, not to be able to go to the store themselves. So pressure on them, kudos to them, and just, open the funnel for them to collect a whole new consumer segment. And, as people are looking for greater value, that even, amplifies that. And the other thing that they had going on is, they, originally had bought Jet. I mean, one of the reasons they bought Jet was they just wanted to learn how to run and build out a marketplace, a third party marketplace. And, again, that was very prescient on Doug McMillan's site. And then, hey, they watched and studied Amazon closely and they said, well, the third party sellers are kind of an interesting group. They're really inventive. They really can sense and come out with product that consumers are interested in, and it goes into this competitive crucible of the marketplace. I want to own the buy box. I want to be on the top of the page. So these are really creative, feisty, innovative entrepreneurs that are on that make up that third party. And so if you get enough of those, you get a lot of insights about, where consumers are wanting to go or, where consumers willing to go with a given brand. And so Amazon or Walmart putting, all of that merchandise then on walmart.com, then Walmart can look at the zip codes and see, what's trending, what kind of really consumers are in this market. Now you have like you can look at your data in terms of who's shopping the Walmart and understand psychographic profiles. Here, this is like kind of so they can make some characterizations here, but here they can make merchandise characterizations based upon that third party purchase activity. And then that can influence what they put on, their own merchandise in terms of the first party on Walmart.com, but it also can really inform how the historic store. So what can we lean into in terms of better and best in a given market with these stores? And so that just allowed them to have really robust traffic and sales growth this year, and it's just been a blazing successful year. So 2024 was a good year, but 2025 was a year where you had that more pronounced K-shaped economy. And historically, you would say we get a more pronounced K-shaped economy that would be bad for Walmart. It wasn't a bad year for Walmart. It was a great year for Walmart.
Mhm, mhm. Man, I just think that when you and I were talking about on the phone yesterday about how these third-party marketplaces, your insight is that they can be a Trojan horse because they're just data collection warehouses. And if you can identify, like, in these zip codes for whatever reason, uh, the boys like Spider-Man, but in these zip codes, it's all about the Hulk. I'm thinking about that because I just bought my son some Spider-Man stuff from Walmart, and they can see that, and that's perfect assortment data that they
Yeah,
can just
and
put
so you
right
can
up in
drive
the front of the store.
you can drive your road rate of sales, and you can reduce the amount of clearance or discounts or clearances, and so you can have a richer merchandise mix. And so I think kind of that's why you have all these retailers that are just pushing so hard on third-party marketplaces. They see it as a way to drive sales, to drive um, relevance, to drive capture more margin. And so when you think about like geolocation data, understanding the true shopper of a given trade area or a given store, using your data. And then you can have some of this third party marketplace insights. I think you take those things combined, and if you can have your machines learn off of it, then you can really have a different business. And I think that's going to be really the exciting or interesting thing to watch in 26 and beyond is, how much further this extends the story for a Walmart or extends the story for a Best Buy, et cetera.
Yeah. Man, there's so much more I want to talk to you about. We're just going to have you come on for another episode. But maybe as we kind of close this one out, how do you think 2026 is going to break? I know you spent a lot of time thinking about this. What's on your mind?
Yeah, it's gonna be I think it's gonna have a one one or the other outcome. I think the first half of 26, I think we're still gonna kind of see more of the same, as we saw in 25, maybe a bit more extension, but I think it's gonna be roughly the same environment. There's really two big, I call inhibitors to the economy right now. One is, mortgage rates being so high, relative to where people refinance mortgages has just created this, golden handcuffs where I don't wanna change my home, but it also means I'm not taking a job into a new market or that would cause me to have to change my mortgage. So that's part of what's creating this labor market that's just stuck. There's just no housing turnover. There's just no labor turnover. So if mortgage rates go lower and you can start to free up some housing turnover, I think that would be helpful for housing related retail and for the economy overall. The other thing that I look at this year is this is the year where for most big companies, it was all in on AI. And it was, we're not doing anything. We have no other priority other than figuring out our AI strategy, building our tools, starting to build out our agents, learning about how it can influence our business. Nothing else. That's what we're doing. And so that's created, no new initiatives investment for like an Advent. It's a challenge because they're not going to buy new software, right? And, and I've heard this from a lot of other software vendors. It's just they're not getting consideration this year because of AI. And, it also means we're not investing in our developing our workforce because we don't necessarily know what our workforce within this new AI world will look like, which means we're not really hiring. So we've got no hiring, no firing. What also means we have no new professional hiring. So you have no, people graduating from college is really, really challenging. I think worse since the great financial crisis in terms of being picked up into an organization. So really gummed up um, labor market just frozen static. And so my hope is that as we get into the second half of 26, that you have people, big companies deciding they can spend time on other priorities, including workforce development and new hiring. And that creates more turnover, it creates more flow within the labor market. It brings new people into the labor market. People feel more comfortable about the economy, their job prospects, their ability to earn more, and they become more willing to spend. And that kind of sets up the second half for a more healthy consumer spending retail environment and not so just doggedly, bifurcated K-shaped economy. So that's my happy story.
Yeah.
My less happy story would be that people figure out, the big companies figure out what they're doing with AI agents. They deploy them. They can see that they can get a tremendous amount of productivity. They don't need the same number of employees that they had, and we start to see large scale corporate layoffs, which freaks the heck out of everybody, which then also creates concern about the economy. And investment, and it just kind of hits a downward spiral. And I have a story about how that ends up, but that's for our next uh, um, conversation. But that would be the scary thing. And um, so I think when I think about the second half of next year, if you start seeing a ramp up of layoffs, and I watch like the results for Costco and Walmart pretty carefully because those have been really fueled by the kind of upper half, and then that upper half starts to really get killed by these layoffs, and that would be a tell that they're cutting back on spending, and we're we're the sad option of those, or alternative of those two outcomes.
Yeah. Yeah. There's a saying that money is just spiritual energy in motion. And when you stop the when you it's a guy named Gay Hendricks, that he wrote a book that's somewhat about that. But when you stop the movement of that energy, it just gunks everything up. And that really I can definitely feel that in the economy right now, and based on what you're saying. Well, I think that when the student is ready, the teacher appears. And I have just such appreciated reading your stuff this year, Thomas. I feel like a third of my LinkedIn posts are actually inspired by reading your blogs.
Ah, awesome.
So I love that. And I would recommend anybody go and check out what Thomas writes at Advan. So Thomas, if people wanted to follow up with you and learn more and read your blog and your insights, how would they do that?
Yeah, they go to advan.com, advanresearch.com. Yeah, so it's ADVAN research.com. And then there's an insight page there. There's all my stories that are in there. There's a free sign up. So you can sign up, and then, within each story, you'll see, way to contact me. So that's just Thomas at advanresearch.com. Sent me an email, and happy to connect you or anybody else that'd be interested in seeing our blogs, and I'd love to have a conversation about data with you.
Rock on. Thank you, Thomas.
Thank you.